Thank you, Safi, for introducing me. Good afternoon, everyone. And I would like to present today the presentation as part of my thesis, The Capital Structure in Russia, Strategic Choice or Credit Constraints. So first of all, starting about the motivation of our research is that capital structure choice is one of the most investigated topic in corporate finance because the debt to equity mix for the strategic development of the company influences a lot angles of the firm, and finally it influences the firm's value. But the problem is that this capital structure theory, the choice of the capital structure theory, is actually developed for the perfect markets, for developed markets which are considered perfect with the one or two imperfections like taxes, existence, cost of financial distress, existence, etc. And these theories were proved for developed markets. But if we look further on at what is happening empirically with the developed markets, we see that the unregulated industries in the US market showed dramatically increased debt ratios over the last century. And this increase was not only explained by the internal fundamental factors of firms, rather than by the government borrowings, macro and institutional environment. On the other hand, there is another very clear trend on developed markets, which is the capital structure conservatism, when firms try to avoid debt financing. And for developed markets, this trend is empirically proved by a set of motives, which are either financial constraints met by the company on the firm level, or a deliberate choice of the firm because of the financial flexibility motives or managerial entrenchment. So our question is whether we could see the similar trends in the growth of the debt ratios, in the existence of the capital structure conservatism on emerging markets or not, and specifically in the Russian market. So if we look at the literature on emerging capital markets, we could see that the emerging capital markets demonstrate much lower debt ratios. Right now, the proportion is like 35% on emerging markets versus 53% on the developed markets. Moreover, this gap is not decreasing significantly in time, and this is probably partially because of the specific characteristics of emerging markets, which are not as transparent as developed firms, that have a high level of the state ownership, high level of regulations, and low property rights legislation, weak corporate governance, and high relevance of the agency costs. So we wanted to figure out to which extent the capital structure choice in emerging capital markets is subject to internal financial constraints or the market conditions which actually restrict firms in their choice. When we look precisely at the Russian capital market, which also demonstrate all the features for emerging markets of the previous slide, we could also state that there is a non-transparent information, high level of information asymmetry, which is observed in the market. It was also figured out that after the beginning of the sanctions since 2014, there is a decreased co-movement between the Russian and global equity markets. If we look at the recent research on the capital structure for the Russian market, we could see that it is not driven by the equity market timing, which is quite predictable, keeping in mind the illiquidity of the Russian market. It was also shown that the capital structure of unlisted firms differs by industries. But the problem is that when we look at the unlisted companies, we cannot actually differentiate each particular company from its from the group of the companies, and therefore we cannot be so sure in the results obtained. Finally, it was shown that the capital structure of Russian largest companies are mostly driven by macroeconomic conditions, but there was a very small sample of the firms in this research. Therefore, we would like to have a broader picture of what is happening on the Russian capital market. To start looking at this, we look at the debt and equity markets dynamics. And if we look at the equity market, we could see that it was dramatically influenced by the major shocks of the financial crisis of 2008-2009, the COVID-19 crisis, and although the sanctions since 2014 are not so clear on the dynamics of the equity market, but we know from the previous literature that there is a decreased movement with the global markets, which also make it more difficult for the firms to attract equity financing. When we look at the further characteristics of these markets, we could see that the market is very underdeveloped in terms of its volume. So the proportion of the market cap of the Russian companies to the GDP is less than 50%, whereas the compared figures for the US are approximately 200%. It was shown in the previous literature that the IPOs are much more underpriced on the Russian markets. We know that there is a predominance of the oil and gas and energy sectors, and that means that the markets are quite dependent on the oil prices. And therefore, we do expect that that there is a lower probability of the equity issuance due to the low liquidity, and we also suppose that the equity financing is too expensive because of the underpricing on this market. The debt markets look a little bit more optimistic in terms of its dynamics. We see that although the firms rely more on bank debt versus bonds, but still the proportion of bonds in the total debt capital increases. On the other hand, we see the consolidation in the banking sector as the number of the operating banks decreases sharply during the last 20 years. And the lending rate is volatile, but recently it became less uncertain. To compare the volumes and the issues of the debt and equity market, we could see on the top graph the emissions of equity in billions of rubles. And we see that the figures are not as high, but as soon as we compare these figures with the issues of bonds, this is the right bottom graph, we could see that the equity issues become absolutely insignificant. That shows that the issue of additional equity is very much limited in Russia nowadays. As for the trading volumes of equity and bond markets, they fluctuate a lot for the whole period of the history that we have. And nowadays, so this year, they are approximately the same. So as we see from the analysis of the debt and equity markets, we still could obtain external capital, but it is too expensive, and there are barriers to obtain this external capital. Another point is that the corporate governance mechanisms are also underdeveloped in Russia. We could see from the recent recently published research that the level of the board independencies in Russia is still under 44%, which is extremely low as compared to approximately 90% in the US. There is a very low gender diversity, which is approximately 13%, and this is for the largest firms in Russia. And the foreign directors constitute approximately 30% of the board of directors. From the literature, we also know that there is a high degree of the ownership concentration, which is not considered as the good practices of the corporate governance. So that is why we decided to have a look at whether the Russian data actually proves that the external capital is too expensive for the Russian firms, and there is not so much scope for choosing the capital structure. We collected a sample of 158 companies for the period of 2000 to 2020. And our criteria was that a company at least once presented at the broad index of the Moscow exchange. We used the Capital IQ and Icon Refinitiv databases and applied several filters on the data availability depending on according to the previous literature. You could see that the number of observations per year slightly differ, but still we decide that we should keep all the firms to avoid survivorship bias. So, sorry. If we look at the snapshot of the debt ratios for the Russian companies in 2020, you could see that the Russian market is subject to outliers. There are firms like Rosbusiness Consulting Group, which have a huge debt ratio of approximately 2.5. So that means that the firm has negative equity actually. And we have firms with no debt at all in their structure. We could also see that there are largest companies on the right, which are mostly concentrated in the oil and gas sector, like the Gazprom, Surgutneftegas, which demonstrate actually mean level of the debt ratios. So when we look at the time trends for the last 20 years, we see an increasing trend in the total debt, which is mostly explained by the increase in the long-term debt, because you could see that long-term debt also showed the increase in trend. On the other hand, the short-term debt shows the mean reverting pattern, and we will see further on that it has a specific role during the turbulent periods. When we look at the coefficient of variation, so to figure out whether the debt ratios became more or less volatile in time, we could see that after the beginning of the sanctions, there is a slight increase in the coefficient of variation. So our interest is whether this is the variation for all the companies or specific industries or between the industries. To figure this out, we look at the industry trends first, and again, we could state that the industry levels of the total debt for different subsectors, first of all, shows that the higher the tenability of the average tenability of the assets of the industry, the higher is the debt leverage. But as compared to the US ratios, we see that our firms are extremely under leveraged. So we then decided to have a look at what is happening with the variance of the debt ratios by industries. You could see on this scatter plot the red observations for the firms with the state ownership of more than 50%, and the blue observations are for the rest of the companies. For the illustration purposes, we omitted the debt ratios of more than 0.9. Most of them were concentrated in the communication services, but they made the graphs not illustrative at all. So we could see from this graph that it is not obvious that there was an increase in the variance inside the industries. To prove that, we looked further at industry by industry coefficient of variance, and you could see here two examples of the highly state-owned industries as energy and utilities, where the coefficient of variance, which is an orange line, are decreasing, and the coefficient of variance are also decreasing in the industries where the concentration of the state ownership is low. So actually we could conclude that the variance appears from the variance between the industries. Further on, we decided to have a look at the role of the crisis events on the capital structure to prove the role of the short-term financing during the turbulent periods. We took the classic determinants of the capital structure, which are size, profitability, tangibility, and the growth opportunities, and also the dummy variables for three sets of the crisis: financial crisis of 2008-2009, COVID-19 crisis, and the sanctions period. For the financial crisis, we see a clear picture of the importance of the short-term debt, which increases sharply during the crisis period, whereas the long-term debt is decreasing. For the sanction period, we see that there was a huge increase in all of the debt ratios, but we understand that it is partially explained by the sanctions, but partially by other set of the macro and environment factors, which we are to investigate further on. As for the COVID-19, again, we could see a huge role of this short-term financing, which helps firms during the turbulent times. So, when we saw that the capital structure of Russian companies is extremely dependent on the institutional and macro factors, it seems that probably the firms prefer internal financing in terms of the retained earnings, and probably they do not pay a lot of dividends. Therefore, we looked at the payout ratios of the companies to look whether they are extremely low, but not. Actually, the payout ratios in Russia are much higher than those on the developed markets, which could be explained that the investors are not so sure in the capital gains, so they request a greater return in forms of the dividends. Further on, since recent years, the government require from the firms with the large state ownership to pay out as the dividend not less than 50% of the net income. And you could see from the bottom table that the firms with the largest stakes of the state ownership pay out more. So therefore, we could state that although the external financing is extremely expensive and there are barriers to obtain it, still firms do not rely solely on the retained earnings, and therefore they still have a kind of a scope for the choice of the capital structure. Finally, we just tried to figure out whether the internal financial constraint matter a lot for the Russian firms when they choose the capital structure choice, and used two measures of the financial constraint from the previous literature. The first one is the division of the firms into dividend paying and non-dividend paying, assuming that the dividend paying companies are less financially constrained. But as we see from the previous slide, the firms pay a lot, and probably this methodology doesn't work well for the Russian firms, and which we could see from our test. is that the dividend-paying firms actually show lower debt ratios. So we cannot prove this hypothesis this way. The second way is to construct an SA index, which is actually a kind of a too big to fail idea. The index is based on the size and age of the firms. We then divide the firms into 4 groups and look at the top group and the bottom group, supposing that the top one is the unconstrained one and the bottom one is the constrained one. And again, we see no proof for the financial constraint hypothesis, since the difference in the means debt for constrained in unconstrained groups are insignificant. To sum up, we show that the macro factors, the states of the financial development of the markets and the institutional environments create barriers to external financing and make the external financing, both equity and debt, too expensive. And therefore, actually, the decision of the Russian firms to choose the debt to equity ratio is a kind of a 2-step. The first one is to estimate these set of the barriers, and then as soon as they are taken into account, there is still a scope for the motives of the capital structure choice to figure out, although we could clearly state that the internal financial constraints do not dominate these motives. So this is all I wanted to present today. We only have the reference list left, and I would be happy to answer your questions and comments. Thank you.
Thank you very much, Maria. Thank you for a wonderful, very, very informative presentation.